and I think this is worth paying attention to. A lot of you have taken my recommendation of becoming stock market investors. Some of you are in my Black Stock Market program. And so I thought I would come in and kind of tell you guys what's going on and what my interpretation is of what's been happening in the stock market. Now, as I kind of get started, I'm going to go live now and shoot out a text message to let everybody know what's really going on, and let everybody know that we're having this conversation. It's a very important conversation. It's a grown-ups conversation. I don't think that as a community, we pay much attention to stuff like that. We're more likely to pay a lot of attention to what rappers are doing and stuff like, all that other stuff. A lot of that stuff is kind of immature. I'd rather see Black people talking about things that are going to make a difference in our lives, like where our wealth is going, how we can keep our wealth, how we can build our wealth, stuff like that. So anyway, what's going on, Terrence Mack and James Brittenham and everybody else who's watching. And don't forget, I'm at the Black Financial Channel, which is theblackfinancialchannel.com. That's the primary place where we're doing this right now. Now, so in case you haven't been following, the stock market has really been plummeting. The stock market this week has been kind of getting kicked in the butt. The Dow dove today. At this point in time, I think it's down about 450 points for the day. For the week, it's down. I want to look at the total. I don't have the total number in front of me, but it's quite a bit. And so there's a lot kind of happening here. There's a lot to kind of unpack. Let me see if I can get some statistics. In fact, I'm going to read an article. This comes off MSNBC. And it says the title of the article on MSNBC or CNBC, sorry, is Dow dives 400 points, heads for worst week in 10 years. So the Dow is literally at a point where it's doing worse than it did, or it's down there where it was in terms of percentage drop. This is the biggest percentage drop that we've had since the 2008 financial crash. And if you remember, that was a time when everybody freaked out, everybody was afraid, and a lot of people stopped investing. And it was a huge mistake because all throughout history, when the market has dropped, it has always recovered. How you doing, Lisa Wallace and Nicole Allen Fisher and Leslie Simmons? Good to see you. And what I really want to definitely reiterate for sure is that I personally don't see any reason why I would stop investing right now. I'm not going to stop. I'm not going to change my strategy. I'm not going to, make any major adjustments, because you don't sort of provide permanent solutions to temporary problems. What's happening now has happened many times in the past. This is what they call a market correction. And also what's really been interesting about this correction is that there's a lot of market volatility. Market volatility is when the market's kind of going up and down, up and down, up and down, up and down like a roller coaster, and it's crazy and you don't know what's going on. And and so I want to kind of just be here. As you guys know, I'm a finance professor, so that's kind of what I do. That's what my PhD's in. So let me kind of explain what's kind of been happening here. Basically, what I'll do is I'll read through some of his article. They said stocks plunged again on Friday, bringing the Dow Jones Industrial Average losses for the week to 7%. So it's gone down 7% for the week, and putting it on track for its worst week since the financial crisis in 2008. Now, one of the things that you may not know about is that there's something in finance that we used to study in grad school called the December effect, which was kind of connected to something that they call the January effect, right? Same thing, January effect, December effect, same thing. And basically it's where in December, historically, stocks drop a lot in December and then they rebound in January. Well, why has that historically been true? It's not true every single time, but it's been a pretty reliable effect. Well, a lot of that is driven by the fact that in December, a lot of people do what they call tax loss selling. Tax loss selling is when you sell so that you can write off the losses, right? So if you have a stock that's been a dog for you, that's been kicking you in the butt, losing money for you, well, there are a lot of people who will do tax loss selling so that they can, go ahead and write that off on their taxes. They may have income from another business, and they're like, okay, if I go ahead and sell the stock, then I can realize the capital loss. I can basically make the loss real by selling this asset. And that will allow me to sort of balance off gains I might have had somewhere else. And then what will happen a lot of times in some cases is people will go right back and buy that same stock right back in January. So again, I don't think that's what's driving all of this. But if you want to know the history, it's not a big deal for the market to kind of take a plunge like this, especially during the month of December. However, this is an interesting month. largely because of the amount of volatility. And also some think that this is a period where chickens are coming home to roost, that basically Fed policy over the last, 15 years has kind of put the economy on steroids. There have been times where our politicians, again, because they're just so bad, they're not very good at agreeing on things, they're not very good on making good long-term decisions. They've kept interest rates too low. My opinion is that interest rates have been kept too low. And when interest rates are low, low interest rates are kind of like this little boost to the economy. Again, kind of like, steroids. Well, the thing about it, though, is if you keep giving, the economy that little boost, then eventually, everything that goes up comes down. Every time, when you have a high, like if you keep drinking coffee in order to keep boosting yourself, eventually you're just going to crash, right? And so we've had our economy on coffee and cocaine for quite a while. So it's been high for a while. And there are people that are debating as to whether or not we can sustain that high, or if the crash is going to be really, really terrible. I know for a fact, my theory, my belief is that there will be a crash. There is no question in my mind, no doubt whatsoever that there will be a crash. The only question at this point is not whether there's a crash. The question is how long will it last? How bad will it be? Some people, look, there are people that predict economic crashes all the time. That's how they make their living, by predicting that the stock market is going to drop. So these people are dancing, are dancing the jig, and they're super happy because they're like, yeah, see, I told you the stock market was going to crash, blah, blah, blah. Well, your prediction doesn't mean anything if the stock market rebounds a week later, right? It doesn't mean anything if the market comes back up. Everybody knows the market's going to crash. I know I do. When people ask me, Doc, do you think the stock market's going to crash? I say absolutely, because it always does. It's been crashing, or it's been having corrections for the last 120 years. Why would it stop now? The question is not whether it crashes. The question is, does it crash and not get better? That's like, illness, like a market correction is like catching a cold. Sometimes we catch the cold, sometimes we catch the flu, sometimes we even get pneumonia. All those things, at least the cold and the flu, can be recovered from. Pneumonia, most of the time you come back from that. Now, if you get Ebola, then you got a problem. So if somebody predicts that one day you're going to get a cold, that's not impressive. Everybody's going to catch a cold. They predict you're going to get the flu. That's not a big deal. Now, if they can predict that you're going to get Ebola or AIDS and die from AIDS, then that's a hell of a thing. Like that's impressive, right? And so basically, there are a lot of these doomsday seekers in the stock market, and what the reason that misinformation is very, very bad for people, especially in the Black community, is because the doomsday seekers are the ones who keep people from investing. They create fear, and fear is one of the greatest wealth zappers that there is. When there's fear, you lose money. When there's fear and when there's fighting, you lose money. So Black people lose a lot of wealth. We lose trillions of dollars a year because we have a lot of fear in our community. We also have a lot of fighting in our community. When there's peace, there's prosperity. When there's courage, then there's empowerment, then there's expansion. But we don't have we don't have as much of that as we'd like. We actually have a lot of fear, which causes people to be afraid to invest, afraid to make moves, afraid to try, afraid to trust each other, afraid to work together, afraid to build economies. And also we have on top of fear, we have those other emotions that cause us to just miss out on the things that could help us move forward, right? So whether you're talking about Black people fighting on the internet and not being able to work together, to Black politicians, to TD Jakes condemning Louis Farrakhan because he doesn't want to work with him, all this fighting causes division where everybody loses because you're not working together. Well, in the economy, the fear and the fighting affects Black people because we don't participate within the stock market the way we could as investors. But then also on a bit broader scale, the United States right now has a lot of volatility in the stock market because there's a lot of fighting. There's a lot of fighting with politicians. There's a lot of fighting amongst between the Fed and President Trump. There's a lot of fighting in terms of people just disagreeing, having differences in opinion in terms of what the Fed's going to do. Why? Well, because there's confusion. There's fighting between Trump and China. So if I was to criticize Trump as president, I don't really get so much into all the politics of it. I don't know if the man's a racist or not. Maybe he is. It doesn't really matter to me. Honestly, it doesn't affect me that much, or affect you. Honestly, I think what you do actually affects you more than anything. But what I do know is that Trump is bad for the economy because Trump is sending mixed messages to the world about what he's going to do next. He's bad for the economy because Trump is fighting with China over the trade war and is giving mixed messages about the fight. The fight itself is a problem, is hard enough. That's not such a bad thing, honestly. He should be fighting with China over trade because China is, they're the pimps of the world. China has been able to really create trade relationships that are just downright exploitative. So I think that fighting with China makes sense, but how you fight is very, very important. In fact, I was talking to my friend who's married, and she was talking about the ability to stay married. And she said, the ability to stay married comes down to the quality of your fights. And I said, and I instantly knew what she meant, because there are couples that fight ghetto and fight like crazy and have ridiculous blowouts that cause the whole house to burn down. Then there are couples who just argue and bicker a little bit and then they work it out and everything's okay. So the quality of the fighting is what really makes a difference. Trump is a low quality fighter. Trump will go out and he'll go back and forth with China. Then he'll go out and make an announcement about what happened with the trade war, what the expectation is. The whole market will celebrate because he'll say something good. Then he'll come back and say something bad. And then the market will get scared and depressed. And then boom, literally $100 billion in wealth disappears like that. That's not intelligent. In my opinion, that's not an intelligent approach to information dissemination, because the market is driven largely by information. It's driven largely by the words of people like Donald Trump. So anyway, I'm going to send out a quick text message to everybody to let them know that we're live on the Black Financial Channel talking about the stock market. If you want to join the Black Financial Channel, take this 1 second and go ahead and go to theblackfinancialchannel.com and make sure you subscribe and hit the thumbs up button. If you're not there, go to theblackfinancialchannel.com. That's where we talk about Black money, Black wealth, Black finance. Is all financial all the time. That's all it is. But it's from a Black perspective, so you don't get this anywhere else. There is no place that's going to be this raw, this Black, this good, and this solid in terms of expertise and information. So I literally have more financial expertise than 99.9% of the people that you're going to see in a Black enterprise or CNBC or anywhere else. But also, y'all know I keep it real. You know that I talk. It's all Black all the time, and it's a perspective you won't hear anywhere else. So go to theblackfinancialchannel.com. Make sure you subscribe. Some of you are on the Your Black World channel. Make sure you also subscribe at theblackfinancialchannel.com. All right, give me 1 second here. Okay. All right, so what I'm going to do is go through and I'm going to kind of break down for you some of the specific causes of the market drop. Now, let's keep the fundamentals here. Now, those of you who are in the Black Stock Market Program, the basic premise. The basic premise is that it's the long-term play that matters. It's the long-term play that matters. Anybody who's running from the stock market now because the market's crashing, it's a lot like somebody who commits suicide because their high school boyfriend dumped them. If you run away from the stock market because there is a crash or a correction, again, that's like quitting your job because you had a bad day. That is not a healthy way to approach anything. That's an unhealthy way to do whatever. It's like divorcing your husband because he forgot to take out the garbage. The long-term losses are going to far exceed the short-term benefits. And so you can't get so caught up in the moment that you throw away the entire future. So that's the first thing I want to say is that if you ask me, what am I doing with my portfolio? I'm making some minor adjustments, but I ain't doing nothing different from what I've been doing already. Everything I've been doing already, I'm going to keep on doing it, because the number one rule of wealth building is you must have the ability to be consistent and to think long term. If you can't be consistent, then you'll never build wealth. Those who are not consistent do not build wealth. So keep that in mind. It's very, very important. So anyway, let me read some of this article. So basically, it said stocks plunged again on Friday, bringing the Dow Jones Industrial Average losses for the week down 7% and putting it on track for the worst week since the 2008 financial crash. That's a big deal. The Federal Reserve's rate hike on Wednesday drove the losses this week, and fears of an extended government shutdown only added to the pain. So you got two major factors here that have really hit people this week, but I think it goes even deeper than that. One is the Federal Reserve. The Federal Reserve went ahead and increased interest rates. And those of you who are in the Black Stock Market Program, you guys know that when interest rates go up, stock prices go down. There are a number of reasons why. I show you guys the equations of how stock is valued and why higher interest rates will drop the value of that equation. So higher interest rates, either reflect, higher cost of borrowing or higher risk levels or higher inflation. Either way, all those variables left alone in isolation, or what they call, oh my goodness, what was the French term for that? I can't find, not laissez-faire, there's another term, I forgot. All else remaining the same. I forgot I got to go back and remember what the term was. But basically, if you hold every other variable constant, and you just change that that one factor, you're going to tend to see a drop in stock prices, right? So basically, when interest rates go up, stock prices go down. That's typically what happens on average. So the Federal Reserve, and there's a whole lecture in the Black Stock Market Program on how the Federal Reserve works, when they meet, how they affect markets, how they affect you. And so the Federal Reserve basically met, and they went ahead and they went forward with their rate hike. Now, there's a game that's being played with the Fed where people are both watching what the Fed is doing. They're trying to get hints from what they say. You know, what are they going to do? They make predictions. But then there's like they don't just watch what they say, they watch what they do, right? And the thing is that what you do sometimes matters less than what you actually say. Or if you say what you do and do what you say, then that's different from saying one thing and doing another, right? Because the market a lot of times is not just built on information, it's built on expectations, right? So for example, why is it that LeBron James can go into a basketball game? Nicole Allen Fisher is making fun of my analogies. I love analogies. I'm like the analogy king. Analogies are a great way to explain all these complicated concepts. So think about, you know, when LeBron James plays in a basketball game, why is it that he can go out there and score 18 points and people can say, oh, LeBron had a bad game? But then the guy on the end of the bench can go out and score 18 points, and they're talking about him all night because it was the game of his life, right? Why? Well, it's based on expectations. You know, people expect LeBron to drop 30 points. They don't expect LeBron to drop 18. When LeBron drops 18, they're like, what happened? What's wrong? What's going on? But if the guy on the bench drops 18, then they're like, oh my God, that's amazing. That's so good, right? Well, the Fed's the same way. Like, so the Fed passes hints. Every time the Federal Reserve Chairman, Jerome Powell, speaks, people want to hear what Jerome has to say because they're trying to figure out what Jerome's going to do, right? So, you know, when he's talking, they'll adjust in advance based on what he's saying. And then when he actually acts and actually makes a move, when the Fed actually decides what they're going to do with interest rates, and that whole mechanism, again, how that works is described in the Black Stock Market Program, then they compare what he said he was going to do to what he actually did. And if the expectation does not match the reality, the prices will adjust even further. Okay, so it's a lot like maybe almost like actually think about sex, right? When sex happens, right? People love sex. It's like really this cool thing. If you haven't tried it, you should try it. It's a lot of fun. And so what the scientists found was that when they looked at the human brain and they looked at the way people react to sex releases dopamine. So, you know, dopamine is a drug in your brain that makes you high, makes you feel good. That's why when somebody touches you, you're like, right? Because it feels good. Well, actually, what they found is that it's not the actual experience of sex that gives you the most dopamine. What gives you the most dopamine is actually the anticipation of sex, right? So when so you get almost as excited just knowing it's going to happen as you get when it actually occurs, right? So the market's the same way. The market doesn't just react when something happens. The market reacts to the anticipation of what's going to happen. So all the way up until the moment that something happens, the market is responding based on information that they have. So if Apple Computer says we're going to announce our earnings on Tuesday, well, the market is already paying attention to the CEO to see what they say. They're looking at the data to see if there's any predictions on what the earnings announcement is going to be. They're anticipating, they're reacting already based on what they believe. If there's a rumor that Apple's earnings aren't going to be what they're supposed to be, or the analysts say the earnings aren't going to be as high as they thought they were going to be, then they adjust to that in advance. And then there's the big moment where finally it happens, where finally the earnings are announced and everything kind of pops off. And then that's when you kind of know if your expectation was accurate or not. So ultimately, the market does the same thing with the Fed. And right now the Fed is kind of doing some weird stuff where the Fed is, you know, they're kind of not showing enough sensitivity to market conditions. Some people feel that way. Some people feel that the Fed had kind of decided that they're going to do things a certain way all through 2018 and 2019, and they're not adjusting to the conditions. So a lot of people were surprised by the rate hike, I believe. But then again, at the same time, the Fed chairman announced, he said, look, we're going to keep watching the market. We're going to keep paying attention. And if we see any indicators that tell us that there might be an issue, we're going to be slow to adjust interest rates. Because think about this, when the Fed increases interest rates while the market is already getting its butt kicked, well, then people are really going to be mad because they're like, dude, like, you know, we're already losing money. Why it's like somebody, you know, already standing in the rain and then you dump a bucket of urine on top of their head. You're like, why would you do this to us while we're already in the rain? So that's kind of the conversation. Like, what will the Fed do? That's one of the big, if you could predict what the Federal Reserve was going to do in 2019, you could become a millionaire off that information. If you had secret information about what they were going to do, you could literally make money from that. That's why everybody spends so much time trying to anticipate that. Now, once again, I'm on theblackfinancialchannel.com speaking right now. Some of you are watching from other platforms because I'm simulcasting. But if you want to join us on theblackfinancialchannel.com, make sure you go to theblackfinancialchannel.com and subscribe. Make sure you hit the thumbs up button if you're there. Also, if you want to actually learn in more detail how the stock market works, which I think is a huge investment for your family. I mean, such a great way, such a great gift for people that you love. Stock market investing is an important key to building wealth. For the month of December, we actually have 75% off a lifetime membership in my program, which you can find out more about at theblackstockmarketprogram.com. That's theblackstockmarketprogram.com. You can also get a degree from the Black Business School when you're done, and you can build wealth for your family for the next 3 or 4 generations. So it's better than, buying a doll for Christmas. Like, I think the gift of knowledge is more important. All right, so let's keep going. So let's see, the Dow Jones Industrial Average fell 400 points in turbulent trading that sent the blue chip index up as much as 300 points earlier in the day, only to trade in negative territory less than 1 hour later. So what they're referring to is that basically the market went like up 300 points. Everybody's happy. Woo, woo. And then all of a sudden, an hour later, the money's gone. So it kind of sucks. If you have a decent sized portfolio and you've been invested in your 401k and you're watching this, it's enough to drive you crazy. That's, that volatility, I don't think is necessary. I think it's being caused by some things that we could control, but that's what it is. The initial uptick came as Federal Reserve Bank New York President John Williams, so the president of the New York Fed, not the chairman of the Fed, the president of the New York Fed, said that the central bank would reassess its interest rate policy and balance sheet reduction in the new year if the economy slows. So the Fed president in New York, there's the New York Fed, and then there's Feds all over the Kansas City, stuff like that, Denver, and St. Louis, and a few other places. So the president of the New York Fed, who's part of the Board of Governors, which is a group of people that get together and really control the economic masterminds for the United States. He basically gave a speech and said, the central bank, we're good. We're going to adjust. We're going to pay attention to what's happening in the market. And we're going to listen. We're going to change our policy based on what's happening with the economy. So that gave people hope. That made them say, oh, this is great. They may not raise interest rates if they think the economy is doing badly. And that led people to push the market prices up. But then the gains slowly disappeared as investors used that short-term pop as a chance to sell more. So what CNBC's interpretation is that so you had the market dropping, and then the Fed chairman or the New York Fed president comes in and makes this announcement, prices go up. Well, they claim that a lot of people, because of that initial fear, started selling. So when they start selling, what that does is that pushes the prices back down, because when nobody wants something, when people are putting more of it on the market, it drops the price, right? So ultimately, that's what they believe pushed the price back down. Now, then they said stocks accelerated to their lows. So this was a low on top of a low. This made things worse after Donald Trump's trade advisor, Peter Navarro, told Nikkei that it would be difficult for the U.S. and China to arrive at a permanent economic agreement after a 90-day ceasefire in the trade tensions. So basically right now, Trump is in a ceasefire for 90 days with China over this trade war. And he's basically, in this 90-day sort of ceasefire period where they're like, okay, you don't hurt us, we won't hurt you. You don't put any tariffs on us, we won't put any tariffs on you. People are watching, the market's watching to say, okay, what's going to happen after the ceasefire is over? Are we going to find a resolution, or are we going to keep fighting? Remember, I told you, fighting and fear tend to cause losses. So if you're fighting and you have fear in the economy and uncertainty, then you're going to lose money. So basically, because Trump has let it out that he's going to keep fighting with China, the market dropped even further. So basically, the Dow, the Nasdaq, the S&P 500 all lost between 7 and 8%. According to this analyst, he says the message people should take home, especially if there's a government shutdown, is that longer term, the prospects for equities are not good. So this person is referring to the fact that there's another factor killing the markets right now, kicking the markets in the butt, which is the prospects of a government shutdown. There's a belief that the government's going to go down and fall apart, and that we're going to just sort of have this crisis occur because Trump or the Republicans and Democrats can't get along. And again, it goes back to my original point. Fear and fighting cause losses, right? So fighting in the government, the likelihood of a shutdown, not the shutdown itself, the possibility of a shutdown as it grows in percentage possibility is going to cause declines in market prices. And so this person's interpretation, which I don't agree with actually, is that the longer term prospects for equities are not good. I don't agree. I think that things happen. Every day there's new information. Every day there's new there's a new event. Something happens, like the New England Patriots, were competing for a Super Bowl a year ago, and then they started the year and they sucked for a while, and then they suddenly got good again, and now they look like they might compete for a Super Bowl again. It is what it is. It's kind of what happens. So I don't think that the long-term prospects aren't good. I think that it's a matter of being consistent with how you invest. That's my 2 cents. So by the way, if you're on YouTube, please hit the thumbs up button. Everybody on YouTube, take 1 second. Please hit that thumbs up button so other people can join this conversation. So let's see. Let's keep going. I'm going to show you guys a chart. If you're on theblackfinancialchannel.com, you can see this chart. So I'm going to share the screen with you on theblackfinancialchannel.com. Here is a chart that shows point changes in the Dow Jones Industrial Average. So this is what's been going on. You see here, December 3rd, you had a big jump. Here, the red represents the drops. So you see it's like rise, drop, drop, drop. Rise, drop, rise, rise, drop, drop, rise, drop, drop, drop. So that's what they call volatility. That's a bad week. That red is red for, these are bloody shoes. Like this red is blood. There's blood in the water this week in the stock market. And depending on what your investing style is, it kind of determines how you respond. Some people see blood and they say that's great. When there's blood in the streets, that's when there's money to be made. Warren Buffett's whole ideology is built around waiting for days where there's blood in the streets. But at the same time, what he does is he also looks at long-term economic prospects to determine, the nature of the decline, how, this particular downturn, has long-term implications on the economy, say the next 5 or 10 years. I would tell you this. I think 10 years from now, nobody's going to remember this drop. It's very hard to tell if a stock is cheap or a stock is expensive. I mean, if a stock is $200 now and then a week later it's $190, you might say it's cheap. But I mean, maybe it's expensive. It may be expensive compared to what it was a year ago. Maybe 2 years ago it was $80, right? So if it went from 80 to 190 overnight, you would say, oh, it's too expensive, I'm not going to buy it, right? But if it was 200 last week and now it's 190, you say, oh, it's cheap. So there's no such thing most of the time. In many cases, I'm not gonna say there's no such thing, but most of the time, what people think as a cheap stock isn't always a cheap stock, and what they think is as an expensive stock isn't always an expensive stock. Everything comes down to what you're comparing it to. So if I'm looking at Amazon and what is the price of Amazon stock? Let me see. Price of Amazon stock. Okay. So the price of Amazon stock right now is what? $1,377. Now, what's been happening with Amazon stock? Let me show you guys this chart again. I'm showing this chart at theblackfinancialchannel.com. So if you want to see it, go to theblackfinancialchannel.com. Now, I want you to look at this chart. And if I said to somebody, okay, is this an expensive stock or is it a cheap stock? Is Amazon expensive this week or is it cheap? So let's say they look at the day and they say, oh, look, it started at 1469 and look, oh my goodness, it's down to 1365. Oh my goodness, right? Like that's a cheap stock, right? $100 off, discount, y'all. Let's get it, right? Let's look at the 5-day mark. Let's see. Over the last 5 days, it hit a peak of 1581, and now it's all the way down to 1373. It's almost $200 drop. Looks like a cheap stock to me. Ooh, looks so cheap. Let's go back a month. Let's see. Okay, over the month, they hit a high of 1772. Okay, all right. So let's look at year to date. Now look at that though. Look at the year. It turns green. Suddenly the red means you were losing money this month, the last 6 months, the last month, the last 5 days, and today. But you go back over the year, you made money. You could have bought it at the beginning of the year for $11.89, right? And so now, if you bought it at $11.89 and now it's $14.60 or $13.77, whatever it is, you're looking pretty good, right? Everything's about perspective. So here, if you look at the last year, Amazon stock looks expensive compared to where it was in the beginning of the year. But if you look at it on a 5-day chart, it looks really cheap. Do you follow me? Does that make sense? If you can't see the chart, go to theblackfinancialchannel.com. That's where I'm showing this chart, theblackfinancialchannel.com. So basically, there's really not typically such a thing as like a cheap stock or an expensive stock, not because it's not possibly true, but because most of the time we don't have the information to even determine whether a stock's truly cheap or truly expensive. It's like saying, what is a tall person? Who's tall and who's short? It depends. If I'm standing next to a little person, they used to call them midgets, but you can't use that word anymore. I think it's politically, or I guess little people. If I'm standing next to a little person or a 5-year-old child, I'm going to look really tall. But if I'm standing next to a basketball player, I'm going to look really short. So am I tall or am I short? Which one is it? Make a point, right? So basically stocks are the same way. So look at now let's look deeper at Amazon stock. Look at this. Look at that chart. Look at that sucker. Look at how low it was back in 2013, where people would have thought that it was an expensive stock back then. People would have been like, oh my God, it's 398. 398 is so much higher than where it was a year ago. Last year it was only 250. It's so expensive. I shouldn't buy because everything's overpriced. Well, you know what? What's overpriced compared to the past, in many cases, is significantly underpriced compared to the future. Like real estate, you might skip out on buying a home because you're saying, oh, home values are too expensive right now. I need the right time to buy. So home values cost too much. And this house used to be 150 and now the market done took off. Now it's 200,000. Well, you know what? In a decade, that sucker might be 450K and you're going to be looking crazy. You're going to be mad at you. You're going to be cussing yourself out because you missed out on the opportunity to buy that $450,000 house when it was worth $200,000. So my point on all this is to say that a lot of what you know about the stock market is BS. It's crap. It's wrong. It's incorrect. Keeps you broke. Keeps you out of good opportunities. Again, fear or fighting or whatever the case may be. So long story, so let me keep going. Let me keep explaining what's going on with the market here, and I'm going to keep breaking this down. If you're on the Black Financial Channel or Your Black World or just anywhere on YouTube, please hit the thumbs up button. Make sure you do that. Make sure you hit the share button, subscribe button. And also, if you want to really study stock market stuff and really learn in more detail, I have literally dozens and dozens of hours of amazing lectures that I put together in PowerPoint presentations and all this stuff that we have in the Black Business School. So feel free to take a look at theblackstockmarketprogram.com. That's theblackstockmarketprogram.com. And right now, again, it's like 75% off for the month of December for a lifetime membership. And you can get a degree from the Black Business School. And the way we teach, we're better than Harvard when it comes to how we can help Black people, because the only people we teach are Black people in terms of teaching you how to survive as a Black person in this country. Okay, so let's keep going. So we're listening to we're listening their risk to that outlook that maybe the economy will slow further. But this is what Williams said, the president of the New York Fed. So the New York Fed president basically made the markets feel better by letting them know that the Federal Reserve is going to be paying close attention to the state of the economy when they make decisions. So when they make key decisions, they're going to factor that in. That made the markets happy. Well, a lot of these things are driven by information and just reaction. You can even say emotion to some extent. No, but listen to this. But the Fed's decision to raise the benchmark overnight lending rate by 1/4 point on Wednesday triggered a new wave of selling across Wall Street early in the week. The move was widely expected by markets, but investors appeared to be taken off guard by Fed chairman. The chairman is the person who is the head of the chairman of the board of governors. The New York Fed president, it's almost like he gave a message that was not consistent with what the chairman's saying. So again, there's confusion, there's fear, and there's some fighting in the economy. All these things are causing this economic turmoil. When there's confusion, there's volatility. Because think about this: when you're in an environment where you're confused, you're like, wait a minute, what's going on? Wait, he said this. Wait, are we safe? No, we're in danger. No, we're safe. No, we're in danger. Right? It will cause a lot of emotional chaos and insecurity. So Fed Chairman Jerome Powell made comments that the central bank was satisfied with its current path to reduce the balance sheet with no plans to change it. Now, what does that mean? That means that basically they were disagreeing with each other. The president of the New York Federal Reserve was saying, we're flexible, we're good, we're going to switch around, we're going to kind of adjust, we're going to make sure the economy is good, we're going to make sure the stock market's good. The chairman, who's the boss, the chairman of the Fed, said, no, we're going to just be consistent. We're going to keep doing what we're going to do. We don't care if the markets are dropping. And that's pretty deep. So let's keep going. So basically, there's a comment by a guy named Anthony Chan, chief economist at J.P. Morgan Chase, who says the concern of the market was, what is the Fed going to do with the federal funds rate in 2019? John Williams, the New York Fed president, told us everything's on the table. They can adjust that path. Then, of course, the markets are really worried about that autopilot situation. And what he's saying is that the market's worried that the Fed isn't going to pay attention to economic conditions or the state of the markets when they decided they're going to raise interest rates or not. And he said, once again, John Williams said that even that is on the table, that if things were to shift, the Federal Reserve will be flexible on that. Okay. So I personally think that the Fed sending mixed messages. And then the next big piece was just the government shutdown concerns. Donald Trump has probably, in the last week or so, erased at least, $500 billion in wealth or more by basically fighting with the government or fighting with the Democrats about this border wall, this $5 billion wall. So think about this, a debate over a $5 billion border wall caused a loss of hundreds of billions of dollars in wealth in the economy. I think that's the problem, right? I think that Trump, even himself as an investor, I'm kind of surprised that he doesn't have an advisor around him who can kind of tell him that, you need to kind of, stop sending so many mixed messages. But yeah, he's big on sort of pushing forward the idea that he's not scared to go to the brink with the Democrats and cause a short shutdown on the wall, or excuse me, shut down the government over the border wall. What do I think he's going to do? I don't know. I can only tell you what I'm going to do, which is to continue to invest just like I did before. Nothing's changing. I'm not running from the stock market. And the reason I have these conversations on the Black Financial Channel and meet with my students about this is because I don't want you to freak out and panic. I want you to kind of get an interpretation from someone that has your best interest at heart and that can tell you what's going on. Okay, so that's pretty much it. That's what's going on in the stock market right now. That's what I wanted to share with you guys. And Deborah Alicia says, thanks for sharing this. Well, I'm going to make you a mod on the Black Financial Channel, Deborah. So, and I see Chubby Curls. She says, wear the hat. I can't find my hat. So I wish I could find it. Once I find it, I will wear my Black Finance Professor hat. Anyway, I'm going to go, guys. Again, if you want to learn about my Black Stock Market Program, go to theblackstockmarketprogram.com, theblackstockmarketprogram.com. You can get 75% off. I think it makes a great Christmas gift for people that you want in your family to have long-term benefits of wealth. And also they can actually get the degree once they're done. And after they watched all the videos, print out the certificate, put it on their wall, frame it, and then start investing. Every Black person that listens to me, I want you to at least download one of those apps, Acorn Stash or Robinhood, and start investing, start building wealth. Everything in the world could be burning down around you. I want you building wealth. Negroes could be fighting like crazy on the internet. I want you building wealth. People can, be sitting around and talking crazy around you and telling you that you're stupid. I want you building wealth because over time, all that matters is the grown-up stuff. Don't get caught up in the nonsense. Okay. So Chris Mogul, what do I feel about equity crowdfunding? I think equity crowdfunding is cool. That's pretty much all there is to say about that. So all right. So I'm about to go, guys. Have a good day, and don't forget to hit that thumbs up button, share button, subscribe button, and the URL once again is theblackstockmarketprogram.com. So I'm gone, guys. Have a good day. I'll see you soon.